Hi everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to take you through a problem in relation to plant merger decision from the topic cost volume profit analysis. These are all a couple of details related to my career. After you watch the full video, if you find the video beneficial to you, give a like to the video and do subscribe my channel so that you will get the notifications of my future videos. Let's get into the problem. Plant merger decision. The following are the operating details of two plants operating under the same management. Plant A, the details are given in the column. The details related to plant B are given in the other column. Sales 10 lakh rupees is for plant A. 8 lakh rupees is a sales to be generated through plant B. Variable cost 6 lakh related to plant A, 5 lakh for plant B. Fixed cost 2 lakh rupees for plant A, 1 lakh rupees is for plant B. The capacity of operation for plant A, it is operated at 100% production capacity, whereas plant B is being operated at 50% of production capacity. These are all the present details related to both the plants of the same business enterprise. It is proposed to merge both the plants. So the business has proposed to merge plant A and plant B. You are required to ascertain A, break-even sales and break-even capacity of the merged plant. So we are asked to find out the break-even sales and the break-even capacity. I mean, at what production capacity level both the plants join together and reach break-even point. That is to be found out according to question A. Now question B, profit and profitability of the operating plant at 90% of capacity. If the merged plant is operated at 90% capacity, what is the amount of profit it is going to generate for the business? Question C, capacity level of operation if profit of 4 lakh rupees. That's nothing but the profit made by both the plants before merger. When both the plants were operated separately, they earned 4 lakh rupees. If the same 4 lakh rupees of profit has to be earned by the merged plant, at what production capacity it should be operated? That's what question C. Now let's have a look at the workings done here. Statement showing cost and profit of plant A and plant B before and after merger. Now you have the columns titled particulars, then plant A at 100% capacity, then plant B at 50% capacity, then plant B at 100% capacity and merged plant at 100% capacity. See, regarding these two columns, you don't have any issues because these are all the details related to the present situation of both the plants. But what about the third column? Why the calculation is done for plant B at 100% capacity? Since we are asked to merge both the plants and do the calculation, eventually that would facilitate taking decisions by the management, we need to find out the cost details, the revenue details or the calculation of contribution at a particular level of both the plants. Since plant A is operated at 100%, we will also find out what would happen if plant B is operated at 100% capacity. That's what the idea. And moreover, we were asked to find out, according to question B, profit and profitability of operating the merged plant at 90% capacity, and therefore it is good to do the working for plant B if it is operated at 100% capacity. That's an idea. Then finally, we will find out the cost and revenue details if merged plant is operated at 100% capacity. This is what the basic working to be done to answer the three questions asked in the problem. Now sales 10 lakh given in the problem for plant A at 100% capacity. The sale comes to 8 lakh rupees for plant B when it is operated at 50% capacity. Variable cost for plant A 6 lakh rupees. Variable cost for plant B 5 lakh rupees. These are all the data given in the problem. Now from sales, if you subtract the variable cost, you come to know contribution. For plant A, if it is operated at 100% capacity, it could generate the contribution amount at 4 lakhs. For plant B, if it is operated at 50% capacity, it generates 3 lakh rupees contribution. From the contribution of respective plants at given production capacities, let us subtract the fixed cost, which is going to be the same irrespective of the level of utilization of the plants. So 2 lakh rupees is the fixed cost for plant A that is subtracted. We come to know the profit of 2 lakh rupees. Then for plant B, 1 lakh rupees is the fixed cost. If that is subtracted from the contribution of 3 lakh, we come to know 2 lakh rupees as a profit. So this is what they said. 4 lakh rupees is a profit if both the plants were operated separately before merger. 2 lakh plus 2 lakh, it comes to 4 lakh. Now, so you understand the aspects that are presented in the first two columns. Now, let's get into the third column. Plant B at 100% capacity. For 50% capacity, if it is 8 lakh rupees of sales, for 100%, it becomes doubled 16 lakhs. If the variable cost at 50% for plant B is 5 lakh, for 100%, it becomes 10 lakh rupees. 16 lakh minus 10 lakhs, it gives us a contribution of 6 lakhs if plant B is going to be operated at 100% capacity. From the contribution, you subtract the fixed cost. Perhaps it is going to be the same amount whether the plant B is going to be operated at 50% or 100% capacities. Therefore, the same 1 lakh rupees of fixed cost is subtracted and we have come to know 5 lakh rupees is a profit if plant B is operated at 100% capacity. Now let us have the working related to merged plant at 100% capacity. Plant A at 100% capacity gives 10 lakh rupees sales. Plant B at 100% capacity is going to give us 16 lakh rupees sales. If you add these two figures, you come to know sales the merged plant is going to generate if it is operated at 100% capacity. What about variable cost? 6 lakh rupees of plant A, then 10 lakh rupees of plant B put together, it comes to 16 lakhs. From the sales figure of 26 lakhs, if you subtract the total variable cost of merged plant 16 lakhs, you come to know 10 lakh rupees as a contribution. From the contribution, you deduct the fixed cost of the merged plant. The fixed cost of A plant is 2 lakh rupees. The fixed cost of B plant is 1 lakh. If you total these two figures, you get 3 lakh rupees as a total fixed cost of the merged plant. If that is subtracted from the contribution of the merged plant 10 lakh rupees, you get 7 lakh as a profit if the merged plant is operated at 100% capacity. See, this is what I explained already. It is necessary to merge both the plants at a common capacity level, preferably at 100%. And that is why we did calculation for plant B at 100% capacity. That's a simple idea. Now let's get into answer the questions one by one. A. Break-even sales and break-even capacity of the merged plant. To calculate the break-even sales, we have to make use of the formula fixed cost divided by PVR. That's a formula. So to find out the break-even point, let us first calculate the profit volume ratio. Contribution divided by sales into 100 is the formula for calculating PVR. Now what is the contribution for the merged plant? 10 lakh rupees. That's what. Divided by the sales of the merged plant 26 lakhs. If you simplify this calculation, you get 5 by 13. In terms of percentage, it comes to 38.46%. Now let's calculate the break-even point of the merged plant. Fixed cost in total, it comes to 3 lakh rupees for the merged plant divided by PVR 5 by 13. If you simplify this working mathematically, you get 7,80,000 rupees as the break-even sales of the merged plant. At what capacity the merged plant should be operated to reach the break-even point? That is what the calculation to be done next. Break-even capacity, break-even sales divided by full capacity. Break-even sales 7,80,000, whereas the full capacity sales at 100% capacity of the merged plant is 26 lakhs. Therefore, for 26 lakhs we need to operate the plant at 100% capacity. Then at what capacity we should operate the plant to generate the sales of 7,80,000, it comes to 30%. So if you operate the merged plant at 30% capacity, you can generate the sales value of 7,80,000, which is nothing but break-even sales of the merged plant. So with that, answer for question A is over. Now B. Profit and profitability of operating the merged plant at 90% capacity. At 100% if you operate the merged plant, the sales it is going to generate is 26 lakhs. So you calculate 90% of 26 lakhs, it comes to 23 lakh 40,000. Therefore, if you operate the merged plant at 90% capacity, it could give us a sale amount at 23 lakhs 40,000 rupees. Now let us calculate contribution. Sales into PVR is a popular formula for calculating contribution from a given sales. After you calculate the contribution, if you subtract fixed cost from the contribution, you get the balance of contribution as profit from the given sales. This is a popular step we normally carry out. So 23 lakh 40,000 into 5 by 13, it gives us 9 lakh rupees contribution. That's a contribution we get from the sale value of 23 lakh 40,000 rupees. From the contribution 9 lakhs, if you subtract the total fixed cost of the merged plant 3 lakh, we get the profit of 6 lakh rupees. Therefore, if the merged plant is operated at 90% capacity, it could generate the sales value of 23 lakh 40,000. From 23 lakh 40,000, the business enterprise could earn a profit of 6 lakh rupees. Now, what is the percentage of it? Profit divided by sales into 100. Profit 6 lakh rupees divided by the sale 23 lakh 40,000 into 100, it gives us 25.64%. Therefore, if the business operates the merged plant at 90% of production capacity, it can earn a profit of 6 lakh rupees, which is nothing but 25.64% of the related sales. Now let's answer question C. Capacity level of utilization to make the profit of 4 lakh. Now required profit is 4 lakh rupees plus total fixed cost divided by new PVR. The required profit 4 lakh plus 3 lakh rupees of fixed cost, the whole divided by PVR 5 by 13. If you simplify this working, you get 18 lakh 20,000 rupees as the sales to be made by the business enterprise. It can generate the profit of 4 lakh rupees. Now, what is the required capacity level of operation in this level? Required sales divided by full capacity. The similar calculation was done earlier into 100. Right. To get the sale amount at 26 lakhs, we need to operate the merged plant at 100% capacity. Therefore, to get the sales amount at 18 lakh 20,000, at what capacity the merged plant has to be operated? It's nothing but 70%. Therefore, if the business operates the merged plant at 70% capacity, it can generate the sales valued 18 lakh 20,000 and that will give the business a profit of 4 lakh rupees. So this is the idea about this particular problem. It's a very interesting problem and I am sure it is required on the part of the learners to watch the video for at least 2 times to understand this concept thoroughly. Thanks for watching this video. I'll meet you in another video. Bye for now, everyone.